Have you ever wondered, do the markets have some kind of a seasonal structure behind them, or is all price action just random? Now in this video I will break down the seasonal tendencies of the S&P 500, how that correlates with other markets, and most importantly, how you can apply this new knowledge into your own trading strategy and refine that trading edge. Seasonal patterns. Why do seasonal patterns matter? And before we get to that, it's very important to understand that seasonality does not equal prediction. It simply increases the probability of you being, let's say, correct in your trading. So even though some seasons tend to be very accurate, whether or not they go up or down, it is still not 100% guarantee. So to conclude, the markets are not really random. There is a certain type of behavior that tends to repeat over time, and this can be seen if we look at the longer term seasonality. So seasonality gives us an overall context of the markets, but again, it is not predictive. So even though we have some kind of context, the markets can still disagree with that. And understanding these seasonal patterns equals better timing, better setups, and better confidence in your trading. So this will really help you with your own trading once you truly internalize and analyze the different seasons. So here we have the 5 key markets. We have the S&P 500 and the Nasdaq representing the stock market. Then we have the 10-year Treasury note representing the US Treasury, which is a very important market by itself. Crude oil, a very important indicator for energy prices and inflation also. Bitcoin, maybe the fastest growing asset out there, I don't know. And we have some lesser markets, also very important. 6E representing the Forex market, and then we obviously have gold. And these are all futures contracts, by the way, except the Bitcoin. And these are the contract sizes that are being traded every day. We have the top 3 here, so the S&P, the Nasdaq, and the 10-year Treasury are all well over 1 million contracts a day. So these are really the top 3 most traded markets out there. And we can see that crude oil already has 2 times less volume than the other ones. And then obviously the Euro futures and the gold futures have a much less volume behind them, but I thought it would be important to include them also. So next thing we'll look at is the market correlation, how these key markets correlate with each other. And this is a very important tool that especially beginner traders need to start to utilize, because this will help you also refine that trading edge. Okay, so here we have the price action charts for all the 7 key markets, which I showed you earlier. And as you can see in this form, it's kind of hard to maybe interpret what's really happening. And it can be quite complicating to figure out how these correlations and reverse correlations work. So to make this data much more readable and understandable, I have actually created a tool, the 30-day correlation heat map. Now this is a correlation matrix. So the way this correlation heat map works is that we have our 7 top markets here on the left, and in the bottom I have also added an extra market here called the VX. This is the VX futures, which tracks market volatility, and it usually moves inversely with equities. So here we have the numbers between 1 and -1, and the closer the number is to 1, the stronger the correlation is, and the closer the number is to -1, the stronger the reverse correlation is. Now if it's at 0, then there's no effect really. So if we look at our 2 most traded markets, which are the NQ and the ES, right? Down here and here also, we can see that they have pretty much 1-to-1 correlation to each other. So whenever the S&P is going up, the Nasdaq is also going up, and vice versa. And then to show a very clear example of a negative correlation. We have the VX and the S&P again minus 89. So this is pretty much one-to-one reverse correlation. So for any trader, it is very important to understand how different markets correlate with each other. And keep in mind that this is just a 30-day data set, so it is not perfect. And what is true for 30 days might not necessarily be very accurate for example, a year or 10 days or whatever. So this is just a 30-day data set. And I recommend that you analyze this heat map yourself. Take some time and learn how these correlations truly work, because this can be a very good extra tool you can look at next to your own traded asset, whether it's futures or options or whatever. It could be anything, and I'm sure that you would really benefit from learning how market correlations work. So now that we understand how the markets correlate with one another, from now on, I'm only going to talk about the S&P 500. However, even if this is not the asset which you trade, this video is still going to be very helpful for you, as we just saw from the heat map. So now talking about the long-term seasonality. Now the long-term seasonal tendencies in fact reveal a consistent set of patterns that happen in specific months or periods of the year. And these patterns reflect macroeconomic cycles, institutional behavior, and seasonal factors. And this is going to be very beneficial for your trading. So this is now the 24-year average monthly return. And I tried to make it 25. However, I just couldn't find all the data for the year 2000. So I wasn't able to do that. Now looking at this graph, we can already kind of see how the markets tend to move in different months. And we can see here that we have the three big winning months, which are April, July, and November historically. And we have the very kind of big losing month, which is always September. And these months are very safe bets, I would say. We have some 50-50 months, which I like to call them 50-50 months. We have January, February, and June. So these are the months that are closer to 50-50 in terms of it could go either way, up or down in that month. Now this is not the way that the average returns are typically shown. So this is typically how the average yearly returns are shown as. When I was doing my background research on the S&P's seasonality, I could only find graphs and charts that look like this. So these are the cumulative numbers where all the averages are added together. And as we can see from this graph, we can't really interpret what's happening month to month. We can only see the yearly direction. And for me, this is not a very useful graph for day traders. Now, if you're an investor, this is probably what you would want to look at. But yeah. Now, as you just saw from that graph, we can clearly say that price tends to follow the same general seasonal direction. However, this doesn't necessarily translate to day-by-day accuracy. So when you are utilizing this information in your trading, this should be used as a monthly bias, but not so much intraday. And certain months like September and April have a very high reliability, while others are closer to 50-50. And this is also very important to keep in mind, depending on which month you are in. So now that we have clearly seen that the markets do indeed have a seasonal kind of pattern, it is also very important to talk about when do these tendencies not work. And we have a very big one. Typically, seasonal tendencies don't work when there are some kind of geopolitical shocks. And here are some example years, so-called anomaly years. We have the 2008 financial crisis, 2020. Everyone knows what happened in 2020. And then the most recent one, we have the 2025 Trump's second term. And even though these seasonal tendencies have a very high reliability on average, there are still these anomaly years when the seasonal tendencies don't apply at all. And it is very important to understand that these tendencies are not guarantees. They should always be used with confluence, news, volume, and most of all the intraday context. What is happening in that day's markets? And coming now to a very important section, here we have the 24-year versus the 10-year average return month to month. And we can see here that the blue line is the 10-year line and the orange one is the 24-year. And we can see here that the months that were very strong in the 24-year, so July and also November, are even stronger in the 10-year average. And also coming to September, September is much stronger in the 10-year than the 24-year. And again, I recommend that you pause the screen and analyze this graph yourself. Moving on now, I would say that the months that are close to 50-50 again, we have February, and what was previously 50-50 month, June, we can see in the 24-year average is no longer a 50-50, but a very clearly positive biased month. Again, we have August and December, which are very close to being almost equal with negative and positive months within the last 10 years. Here we have the 24 versus 10-year cumulative graph, and the only difference really here is the gain or the returns have gone up in the past 10 years. And again, not really all that useful for day traders, but if you're an investor, then obviously it is a very useful information, but can't really interpret what's happening month to month based on these cumulative graphs. So that's why we're looking at the monthly averages separately. So this is the data set which I used to make the 10-year graphs, and I thought of something interesting making this video, that instead of looking at the average, I wanted to look at the most often occurring, and also looking at the returns that way. I think we get a clearer picture on what's really happening, because if we just look at the average, that is only an average. Although it might be correct, it's still better to look at both, I think. So let's look at the positive months that are very often positive, and very clearly we can see here that we have April, May, June, July, and November. I'm actually going to make those green. So we have 5 green months that very clearly have a positive bias. And if we look at months that are very clearly negative, there's only really one, and that is September. And even that is not 100% negative, like July is 100% positive for the past 10 years, for example. So we have 5 positive months and 1 negative month. So now let's look at the 50-50 months when it comes to most often occurring. So in January, we have exactly 5 positive years and 5 negative ones. So that's a 50-50. Same goes for February and same goes for October. So we have 3 50-50 months, and then the remaining ones are 60-40. I wouldn't necessarily class those as positive months, since it is 60-40 and not 70-30. So we can very clearly see here that some months tend to be 50-50, where they could go negative or positive, and some months are very strongly positive, and then we have September, which is very strongly negative, and then we have our 3 kind of 60-40 months where it's most likely going to be positive because the economy is growing, but it could still be negative. And I really feel like looking at the raw data this way complements very well with the month-to-month average. Now it is important to use both, but I just thought that this would be an additional help. And also you can pause the screen and make your own analysis and whatever. So coming now from our data set, we actually get to the practical portion, and this is the most important part of the video, I think. So how do we apply this new knowledge, this information to our strategy? Because it doesn't really matter what we know if we can't use it. So how do we apply it? But before that, we have to understand that we should not use the information which we have learned as predictions. It is simply a bias, a monthly bias that should be in the back of your head before your day trading session begins. And it is also important to look at the other markets. Now that we know how markets correlate with one another, it is important to wait for confirmation in the correlated or the inversely correlated instruments. Now this is a very basic example on how you can use this seasonal tendency knowledge in your trading, and I have taken a week month as a first example. So we're talking about September now. Since September is typically weak, meaning it goes down, it is best to have a selling bias, especially if the prior day was strong, so going upwards, since the rallies during these weaker months often fail or get faded. Now looking at the other example, so we have the strong month April. Since April tends to be bullish, it is important to have a buying bias. So this is the underlying bias you have when you are in that month. Now months like December, which are the so-called neutral months or the closer to 50-50 months, it is very important to have a neutral bias and wait for the confirmation. So you have to wait for the markets to tell you what they're going to do rather than having a monthly underlying bias. Now to summarize, seasonality shows historical price tendencies. Correlations between different markets can add your own trading confidence, and some months such as September and April show very clear tendency, and others are closer to 60-40 or 50-50, as you saw from the data set yourself. Now remember, seasonal bias is not a signal on its own, so using that will not make you profitable. It is simply a contextual filter. Very important to remember that. Now, in my opinion, swing traders can apply this knowledge more, and this can translate to having better entries and exits, and also having better targets. So really understanding the monthly and weekly seasonality can give very good edge to swing traders, in my opinion. And for the day traders, it is very important to filter the daily bias. So you have to always look at what's happened that day as well. And the way I use seasonal tendencies in my own day trading is that I try to look for setups that align with the expected directional tendency of that month. But that doesn't mean that, if we are in September, that I never buy the market, obviously. But I'm more heavily biased to sell. And just lastly, this is a very simple checklist. Before you use this information in your trading, remember to do these steps. So check the seasonal bias. This is the underlying bias which you're going to have. Then you have the market context, so fundamentals, long-term trend, and market correlations. And then you have the short term, the most important one, the intraday structure, order flow, and whatever else you use in your trading. Now I hope you enjoyed this video. Leave a comment down below. What topics should I cover in my future videos? And if you have any questions about this one, if you like the video, you know what to do. If you like my channel, you know what to do.